Warning, this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel and this is your weekend's deep dive. If any of you are new here, on the Saturday video we tend to have a go at macro, right? And these days I think it's harder than ever to be a macro guy. I am primarily a technical trader. We call the trades out ahead of time. We spend a heavy focus on the channel looking at the technical analysis. And then of course I show you all the positions with the stop loss levels made public. Like I said, on a Saturday, we like to come back and have a go at macro. The main reason I do this is because of my approach to markets. My approach to markets is that I build a framework or a hypothesis, a base case of expectations. They are not predictions. I want to make this clear. They are not predictions. They are expectations. And then I like to come back on the weekend, take a look and see if anything has become invalidated and look for signs of confirmation or deterioration in the idea. All the while, invalidations have not occurred. Then we continue to take this thing one day at a time. We continue to just track this thing in real time and try to use that as a set of ideas and expectations to keep me on the right side of the trades. Since last Saturday's deep dive video, quite a lot has changed, but I think it's gone in our favor, not against us. I think if anything, we've made some significant steps towards further validation of these ideas. And so I'm going to take this thing from the top and we're going to check in and see just how it's looking as it stands. So this idea is largely comprised of a couple of things. One, that from the lows, everyone was too bearish and we would run to all-time highs. I should say, because someone is always quick to point out, okay, this was an arbitrary yellow squiggle, not designed to predict price or time. It was simply an illustration to say, I think we're going to have a big blow off top that culminates in a deflationary bust and a big global recession. My expectation for Bitcoin was that Bitcoin would quite possibly put in an all-time high before its halving. It would then go on to form a left translated cycle top, meaning it peaks before November of this year. Whether that peak occurs in the next week or two or all the way out to November, the expectation is that rather than the market looking at the top for Bitcoin coming in at the end of next year, as we normally would, followed by a 12-month bear market, that in fact we would top a lot ahead of schedule and then have to spend the remainder of that 4-year cycle, measured bear market low to bear market low, in a decline. Checking in on today, and I believe that things are looking more likely than ever before. The stock market, I believe, is setting its blow off top as we speak, and I like to use, rather than a parabola and stretch it to fit and then cheat it a bit, I prefer to use 3 angles of attack of increasing steepness. I believe we have either set the third angle, okay, something like this, or that we are due for perhaps a little bit of a pullback, a little bit of a shakeout into the following week, and then out of that low, wherever that low forms, which I do expect to be above both this second angle and the prior low, for that to become our third and final blow off top angle somewhere in here. So whether that's it and it's in and we're already in blow off top mode, or whether we have a little bit of a shakeout and then we set a slightly less vertical angle, I do believe that we are in the process of setting this blow off top. And I've been saying the entire time that if we do indeed set a blow off top, if we continue to increase in steepness and velocity to the upside for risk assets in general, then typically these blow off tops and parabolas tend to violate to the downside. When they violate to the downside, they tend to do so in spectacular fashion. I have been speculating, as per this piece of white text here, that there will be rate cuts that show up as a result of something breaking. I believe that the market has been completely wrong in expecting higher for longer and listening to the Fed. I do not believe the Fed is going to be able to continue with this narrative. And I've got a lot of evidence that has taken this from speculative to, in my humble opinion, quite likely towards the end of this presentation. So again, even a week ago, this was a highly speculative thing, okay? People were saying that the inflation is sticky and that there's no chance of seeing rate cuts anytime soon. I was using the bond market to show you that actually that's not entirely true. The bond market doesn't believe it, just like I don't believe the inflation is sticky, and just like I don't believe we're not going to see any cuts in the not too distant future. And as I said, there's significant evidence confidence that is now shifted in our favor to suggest that these rate cuts are indeed coming and inflation is indeed going to continue to come off. So again, this was a highly speculative idea at the lows, but now all we have to do is continue to be right for a few more weeks, continue to increase in steepness, and we will indeed have all the hallmarks and characteristics of a blow off top. As I just said, if we do indeed get a blow off top, usually these things violate to the downside in spectacular fashion. All of that would align with this second portion, right? The downside arrow. And I've been speculating that this will occur with a deflationary bust and a global recession. Again, I know many of these ideas are not popular. Many of these ideas go against the grain in the mainstream narrative, but hopefully by the end of today, you will see that this seems to be a very real possibility and is still yet to be invalidated. Really interesting thing about this current blow off top that we apparently are working on is if this thing continues to play, then all of this, okay, this blow off top, this parabolic advance is occurring within a major parabolic blow off top that spans all the way back to pre-2000. And for Bitcoin, we are largely moving as expected. There have been a few wobbles along the way, but overall, this thing looks to me like it is thinking about setting a third and final blow off top angle. There is currently some work to do. If we can just continue to get some acceleration out of Bitcoin, then again, it's hard for me to move away from these ideas because they seem to be more likely now than ever before. We've also got some nice confluence with the Elliot wave count as it stands. Since this chart put out by Tony the Bull, we have made it up to roughly this area. Okay, we are roughly trading around this area right now. It makes me wonder if what we have left in front of us is one final push up to that left translated cycle, just like I was talking about here, followed by an extended bear market decline. Of course, if we do get something like this, we'll have to be open to seeing some kind of double pump, right? Something like this, and then we go on to make a right translated cycle as always. I don't want to get too far ahead of myself. For now, I just want to focus on, can we get out near the top? And then if we do have to entertain a double pump and a breakout, of course, I can be buying a breakout lower down as well. But for now, like I said, I want to see if we can indeed set that third and final angle. Can we indeed get a final push and a trend line breakdown? And if I can, particularly if that coincides with a stock market breakdown, okay, then I want to be exiting risk at least for the short to medium term and looking to buy dips later on in life. So that was the technical expectations dealt with. That is what I've been expecting to occur in Bitcoin and the stock market. And so you're probably wondering, how is it then, Camel, that you are expecting to see continuation of disinflation before ultimately snapping into a deflation, particularly against a narrative out there of sticky inflation and higher for longer rhetoric pertaining to interest rates? And there are many reasons for this. First and foremost, anything you do to the M2 rate of change tends to show up in the US inflation rate with around an 18 to 19 month lag. We had done very, very well on this channel at picking the top in inflation, following this thing down. We even nailed the sideways wobble, which showed up here as a sideways wobble. And we were calling for this piece of M2, okay, the third and final leg down in the rate of change of M2 to start to show up in the CPI print. We saw this for just 1 month show up in the CPI. We saw what looked to be the continuation of this downside move. And then they went ahead and changed the way they calculate the CPI, which gave us a few more months of counter trend wobble. This led retail and the mainstream consensus to very quickly pivot to inflation is sticky. You're never getting your disinflation, Camel. You're certainly never getting deflation. And I said that whilst, as always, I am open to being proven wrong, I am open to being invalidated, I am open to pivoting stances if the market and the data tells me I need to. I was saying that I wanted to maintain this stance and give it a few months of space just to see if eventually we would start to see this CPI come off. And again, I say it is because anything you do to the M2 rate of change tends to show up in the CPI with around an 18 to 19 month lag. We had been successfully using Trueflation to track this. And again, right around the time they changed the calculation for the CPI basket, there started to be an enormous divergence between the government reported rate and the Trueflation metric, rendering that Trueflation somewhat useless as a tool, although it was very, very useful all the way through this portion to about here. I still maintain that there are signs underneath the hood, such as the TMC Global Credit Impulse, which tends to lead by 18 months. The CPI data, this is telling us to expect continuation to the downside, more and more colder inflation prints to come in before eventually perhaps even a slip into deflation. I was also speculating that China perhaps would export its deflation to the rest of the economy and perhaps would also function as a leading indicator for deflation in the US. And so this week on the Tuesday, we then saw PPI come in quite hot. And this made a lot of people even more convinced in their assessment that inflation was indeed sticky, that we were not going to see continued disinflationary periods, and we certainly were not going to get deflation. That was until the following day when the CPI data was released. And whilst I would personally say this is nothing to write home about at this stage, this is certainly not something that I'm getting very, very excited about. The facts are the facts, the data is the data, and the CPI did come in colder than the prior readout. So going back to here, it makes me wonder if this wobble is finally over and what we are about to see is the rest of this downside move start to manifest in the inflation data. I'm certainly not declaring victory at this point. I am, as always, open to all possible outcomes and willing to pivot if the data proves me wrong. But for now, at least, I remain cautiously optimistic that my assessment of this part of M2 rate of change presenting in the CPI showing up over the next few readouts. As I said as well, we've got this TMC global credit impulse also indicative that we will see inflation continue to come off. And whilst I personally don't really care about the inflation, whilst I don't think it changes much in terms of the stock market and Bitcoin's price movements over the coming days and weeks, the big thing for me is I want to see how it's going to impact the probability of seeing rate cuts again, because this goes against the mainstream narrative. This goes against the retail narrative of higher for longer. And even around a month ago, retail was talking about, it might have even been less than a month ago now that I think about it, retail and the mainstream were talking about putting rate hikes, another rate hike, back on the table. I believe the market has this completely wrong. I believe the market is completely wrong-footed here. The colder CPI print, you can see, has reduced the probability, although nominally, of being paused in June's meeting. When we start to click out to July, 1 week ago, we were at 74% probability of remaining paused in July's meeting, and now we sit at around 70%. Again, it's not a big enough change to write home about, but it is data going in the right direction, in the expected direction. We can see the same trend of a drop-off in rate pause probabilities for September's meeting, and we can see this same trend, albeit nominal, for November. So herein lies the issue, as far as I can tell. The market does not expect to see any rate cuts, at least according to the CME probabilities, until November's meeting. And this, of course, against the narrative of sticky inflation, I believe is wrong-footing retail. There are a number of reasons I believe these rate cuts are coming sooner rather than later, which I'm going to go over now. First of all, unemployment is getting worse and worse and worse. The yellow here is the temps, and they are currently leading a rollover in U6 unemployment. We've seen this before here, here, and here, each time resulting in a recession and very tough times for the stock market and risk assets. We've also got California in black, leading potentially higher the unemployment rate for the United States in green. Again, this is another sign of stress. And remember, even if the inflation is sticky, a spike in unemployment could force the Fed's hand and force these early cuts. There's a similar look here for the Kansas Fed labor market conditions in white, leading the US unemployment rate higher again. And each time we saw this in prior occurrences, tough times occurred for the stock market and recessions quickly ensued. I've also been tracking this SAM recession rule, which lags by 1 month. This does not yet include April's data, but is pressed right up against the trigger line. So by the time we get out to including April's print in this, we are likely going to have triggered the SAM recession rule, which has already flashed in 19 states across the USA. So I believe the writing is on the wall in terms of unemployment, unless something changes very, very quickly, unless we start to see these things roll back over, unless we start to see temps start to curl back up and this start to curl back up as well, then again, I think this has ominous implications. Rate cuts could be closer than most people want to entertain, and we may well be staring down the barrel of a recession, again, much sooner than most people are anticipating. I'm about to show you as well the bond market agrees with me, but before we get to the bond market, I wanted to point out a couple more things, okay? The small business optimism is at very low levels, historically speaking. It has dropped for the third straight month and is now sat at 11-year lows. And remember, these businesses are a major part of the economy, accounting for around 44% of US GDP. Speaking of US GDP, of course, the last readout came in significantly below the expectations. Again, another sign that under the hood, cracks are starting to emerge. And all of this against a backdrop of a consumer that is already struggling. You can see at the top, personal savings rates, okay, at pre-C19 levels. Meanwhile, the total US consumer credit that is outstanding continues to climb and is now sat at over $5 trillion. So the consumer is in a really, really, really bad way. They have no savings, record amounts of debt, and what's worse is they are possibly about to start to lose their jobs as well. Possibly about to start getting laid off at work. Of course, when they are laid off at work, they will start to struggle to service their debt. They certainly won't have any money to put in the stock market, and all of this is synonymous with seeing recessions. Furthermore, as I was saying at the start of this video, all of this is occurring at seemingly the crescendo of a blow-off top move in the stock market and risk assets, with Bitcoin thinking about setting its third and final angle as well. And if these red lines that I've drawn on this arbitrary yellow squiggle is even approximately accurate, it tells us we could be seeing a top somewhere around July. Again, this is not a prediction, this is not a call, this is an expectation hypothesized at the lows. And since then, I have simply been an observer. I've simply been sat back watching this thing unfold, and it seems more likely now than ever before. Things can change and they can change quickly, but if they do not change pretty soon, then we will likely be up here. And if you just pause for a second to think about the implications of that, what do you think comes next? Particularly, of course, if the CPI continues to come off, particularly, of course, if unemployment continues to get worse, if GDP continues to slow, and if the consumer continues to be poorer and poorer before ultimately perhaps losing their job. So if CPI can't come down, and force rate cuts. Perhaps unemployment will. Perhaps a combination of both of them will. Again, as I was saying earlier, I'm going to show you the bond market because the bond market agrees with me. But just before we get there, I wanted to point out a couple more things, okay? Shelter makes up 70% and is a lagging component in the CPI basket, okay? And you can see from this chart right here, when we use the real-time shelter inflation, it gives us a number of 1.94%, significantly below the 3.4 when we use the lagging component. We also see this with core. With core, when we use the real-time shelter component, we are down at 1.8% below the 3.67%, which incorporates the lagging component. And the same with the shelter 12-month change using the BLS housing metrics in black, giving us around 5.66%, versus when we use the real-time metrics, we are only down at around 1.38%. So once this shelter component starts to be priced in correctly to the CPI, once it starts to catch up, we will likely continue to see the CPI come off very rapidly. And as I was saying before, if that doesn't do it, then perhaps the unemployment spikes will. And it is indeed a wild time to be alive. Because when we put things into perspective, all US stocks are now worth 187% of US GDP. This ratio is known as the Buffett indicator and takes the total stock market cap and divides it by the US GDP. Based on historical data, a ratio below 82% is considered significantly undervalued, 106 to 129% is considered fair valued, and a ratio of north of 153% would be considered significantly overvalued. Today, we sit at a whopping 188%, and we can do the same with the total market cap of the stock market divided by GDP plus the total assets of the Fed. Again, a significantly undervalued time to buy stocks would be when this ratio sits below 68, fair value would be 88 to 107%, and a ratio north of 126% would be considered significantly overvalued, not an ideal time to be buying stocks. Meanwhile, this ratio currently sits at 149%. So valuations are completely cooked. Under the hood, there seems to be more and more cracks. The inflation narrative, I believe people are wrong on. I believe people are also wrong on this rate cutting narrative. And again, I think all we really need to see is a few more weeks of squeeze to the upside, and it will be time to start being on guard for major breakdowns and a massive, massive shift in market behavior, and perhaps have to start to entertain the onset of a major global recession. And when we take a look at the yield curve against the stock market, what we find is we put in unconfirmed highs in the tech bubble on bearish RSI divergence. We then saw the yield curve revert above the zero line and we entered a bust. We had the same thing in the 2008 GFC where we saw more unconfirmed highs on bearish oscillator divergence with a reversion back above zero for the yield curve. We saw a very, very similar setup in the C19 plunge with the yield curve again reverting back above zero. And now we are apparently on our way back towards the zero line. So I think there's a little bit of time, but if this yield curve reverts back above the zero line and starts to accelerate, again, we've got the bearish divergence on the RSI. And at the hard right edge, we apparently are putting in some kind of major blow off top. So this will be yet another sign to look for. If we can indeed get that yield curve revert above zero, then historically speaking, it tells us to be open to seeing tough times for the stock market and risk assets in the not too distant future. And lastly, for me, this is the biggest piece of signal and the biggest piece of alpha pertaining to understanding that rate cuts are likely coming sooner than most people can anticipate. Is in green here we have the US 2-year bond yield, and in orange we have the Fed funds interest rates. Each time the US 2-year yield leads lower, the onset of a rate cutting cycle from the Fed follows shortly thereafter. It was the same in every single instance. 2-year yield leads lower and the Fed funds rate experiences the onset of a cutting cycle shortly thereafter. At the hard right edge, we can see that perhaps this is a lower high looking to lead lower, and if that is the case, then the bond market is telling us that the Fed is bluffing. It is not going to be maintaining a higher for longer rhetoric, and in fact is due to cut rates much sooner than most people are anticipating. What is really, really interesting about the 2-year yield is it is currently undergoing what I believe is breakdown, retest, and possible resumption to the downside. I was saying that we should be open to seeing a counter trend bounce, perhaps even another push up before then we confirm that rollover. But if indeed this thing does roll over, whether it is like my yellow squiggle suggests or whether it comes maybe from somewhere in this neighborhood, if indeed we do see the 2-year yield lead lower, then based on historical data, it tells us that rate cuts are possibly coming in the not too distant future. Again, way sooner than the market and the mainstream would have us believe. And of course, the reason this is so significant is once the 2-year yield leads the Fed funds rate into a cutting cycle, historically speaking, the market, stock market, risk assets top within 0 to 2 months of the onset of that cutting cycle. We saw it here. A few months later, the market crashes during C19. We saw it here in the GFC, okay? 2-year yield lower, Fed starts cutting rates, stock market puts in a major top. We saw it back here as well, back in the dot-com bubble. So the setup at the hard right edge, the setup today is indicative that if this 2-year yield does indeed lead lower, the Fed will be forced to cut rates way sooner than people are anticipating. And historically speaking, that has aligned very, very well with being close to a top in the stock market and risk assets. Again, I suggest to you that if all of this occurs after a couple more weeks, maybe so anywhere between 2 and 8 weeks of upside squeeze, if all of this occurs against the backdrop of Bitcoin coming swinging out of here and setting its third and final blow off top angle, then I think we'll be able to look back at everything I've presented today with hindsight and say, actually, that kind of made sense. I've also left myself a note here, Nifty 50 and the UKX. And the reason I've done this is because the Nifty 50 led the market. You can see that the Nifty 50 back in June of 2022 put in its low and then was the first major index to make a new all-time high. You can see since then it set not only 1, 2, and 3 angles, but is now apparently, if we zoom in, looking an awful lot like a distribution top. Very, very similar to Bitcoin's top back here from 2021. You can see drive, higher high, lower high, roll over. Today for the Nifty 50, not only have we got a third angle breakdown, but we've got higher high, perhaps a lower high before the rollover. So the Nifty 50 led on the way up. I am suggesting it's probably going to lead on the way down. Shortly after the Nifty 50 found its bottom and made a run to new all-time highs, the FTSE 100 was the next to lead. The FTSE 100 found a bottom at the same time as the US equities around October of 2022, and then it smashed through its all-time high as soon as around February of 2023. Meanwhile, it took almost 11 months from this all-time high point for the UK 100 for the US equities to break through their all-time highs. Again, the FTSE was something we were tracking in real time along with the Nifty 50 and the DAX as they went on to lead the US equities to all-time highs. This was at the time a major component of the blow-off top idea that we were seeing the Nifty 50, the FTSE, and then the DAX go, and that since all three of those had bounced off of their lows and put in an all-time high, that the US equities would follow thereafter, and of course they did. So as I've shown you with the Nifty 50, it led off the lows, it led to new highs, and then it seems to be leading in terms of putting in a top and being about to roll over. Meanwhile, the FTSE 100 now appears to be setting its third and final angle, its blow off top, perhaps as high as 9 and a bit K. There's also a possibility that it hasn't actually set the third angle yet, and possibly what it's going to do is something more like this, right? Some kind of pullback, set a third and final angle, and then go. But what I'm suggesting to you is just in the way the Nifty 50 led its way to the top and then topped, just in the way the FTSE was the second off the lows to make a new all-time high, I now am suggesting to you that the FTSE is leading the US equities once more. The FTSE 100 is going to have this blow-off top and a meltdown in the not-too-distant future, and all of this is going to be a leading indicator for the US equities. So I wonder, therefore, if the Nifty 50 and the FTSE, just how they led off the lows and gave us a leading indicator for what was to come for the US, I wonder if that is what we're seeing now. I wonder if they can continue to be leading indicators for the US equities, and thus it tells us to keep an open mind about seeing this blow off top followed by a major top in risk assets. Again, people don't want to entertain that we might be just weeks away from a top. I should also point out at this point, I would rather be invalidated on this idea. This is not me making this call because I want clout, because I want to be able to come back and say, I told you so. It is nothing like that. I would much rather be invalidated. I would much rather that this thing just continue to kind of have a rough trend this way. No blow off top, okay? No recession, no global deflationary bust, no emergency rate cuts. I would much rather that because we've done a very, very good job on this channel of capturing this move and riding the waves the entire way up. I would much rather continue to buy dips in an uptrend, continue to buy at cycle lows, and continue to capture this trend for years to come. I would much rather that be the case and be completely invalidated on this blow off top. Based on everything I've shown you, I believe the market is offside. I believe the market is completely wrong-footed. I believe this final leg up is going to be driven by fear of missing out, by greed, by euphoria, by people going max leverage to make up for the fact that they missed the entire move off the lows. If indeed, when we come back in a few weekends' time, we are trading somewhere up here, with Bitcoin also trading way, way, way higher up in that third and final angle, then all I will be able to do is continue to say that this thing looks yet to be invalidated, and we will have to react accordingly at the time, of course. So what a wild time to be alive, keeping a very close eye on the FTSE over the coming weeks. I want to see if this continues to be a leading indicator. And so with all that said, I want to take a look at the charts with Dixie into support, okay? If this thing can break down and do something like this, then believe me, this will provide massive fuel to the upside to see a big parabolic blow off top. I don't think it has to happen. I certainly think if we continue to bounce off of here, then that just speaks more to this deflationary bust and dollar milkshake theory in play. But either way, if this thing does indeed break down, then you better believe fireworks are coming very, very quickly across risk assets. In terms of the stock market, we are currently long, having hopped out somewhere back here. We are strong and we continue to push. As I was saying with the FTSE, I wonder if this is the third and final angle, but I also wouldn't be surprised if what we've got is some kind of shallowish pullback that comes first, ends up setting the third angle, and then we go from there. That would not surprise me at all. I am currently looking for a half cycle low to buy in the NASDAQ to add on the NASDAQ. I would likely continue to push this until it is invalidated by losing the second angle or the cycle low. Getting close to around the halfway point of this current daily cycle. This is the NASDAQ now. I wonder if what we get is something like this, a little bit of a pullback, half cycle low, and go, and out of there, I can be looking to get long something like this, and that would be me at full exposure. For the Dow Jones, here it is, okay? It's set its second angle, right? I'm pretty sure that's it in there. And similarly, either this is the third and final angle, or we're about to set it over the next few sessions, and then we should have our third and final blow off top angle after we've made it. Either way, long and strong continue to push, fresh closing all-time highs, happy days, long and strong there. And the Russell 2K as well, continuing to see breadth widen, continuing to see escape velocity try to be reached here. The gold and silver markets starting to do gold and silver things. Nothing more to say about this apart from long and strong continues to push, and the same is true of all those positions we've got pertaining to gold and mining stocks in the members section. Silver has closed probably one of the most significant candles across all markets for this week. Okay, this is a break above that key $30 level. This is even more exciting for the precious metals markets, because when silver and gold are in a bull market, we would expect to see silver leading. That appears to be what is going on at the moment. So do we have to come back and retest 30? I wouldn't be surprised if we do, but I do expect to see a quick snap. There really isn't a lot of overhead resistance here. Okay, if we go all the way back out, there's hardly anything now up until about 35, and once we're above there, it should be a pretty quick shot up to around $50 plus. And if all of this can occur against the backdrop of a softening dollar, then I think the fuel is there to see a very quick snap up for silver and for gold as well. Oil, I'm still playing patient. I'm looking for some kind of trap to the upside and then a quick reversal, and that's where I'll be looking to get short for oil. I'll be targeting way lower down. All of this fits the narrative to see CPI come off over the coming months. It also fits the idea that we're going to have a slowdown in the economy and thus have less demand for oil. So again, a little bit more patience, and I think it'll be time for me to enter a short in the not too distant future. Bitcoin, we were waiting for a cycle low. We were hoping for an undercut. We didn't quite get it. There are two possible ways to interpret this count. Either we've got an early cycle low, we're already over a quarter of the way through the cycle and we haven't done much, or perhaps we've got a timing based cycle low in here and this is about to start coming out of here swinging. There's also a third scenario here, and I was laughing with Kemazabi about this yesterday. He was saying we could already see the comments, but there is another scenario that we haven't actually found this cycle low yet, and that we could go all the way out to perhaps something about the 25th or 26th of May to give us a day 66 cycle low, which would still be legal and qualifying. And thus we would be expecting something like this, a rollover into a cycle low and go. I personally don't think that's very likely. And the reason I say I don't think that's very likely is we've had a change in market structure. Okay, we closed candles above the prior swing high from back here. We also are working on taking out this swing high from back here as well. I would say, based on this, it seems pretty likely that the cycle low is already in. And I don't think we get that rollover and that undercut. But it's certainly one scenario that we cannot take off the table just yet. If indeed we did see a rollover and undercut into a day 66 cycle low, then I would actually be more than happy to be stopped out on this position in exchange for being able to re-enter at a day 66 cycle low, which would be a high probability setup. It would tell us we got a full 60-day cycle ahead of us. And I'd be more than willing to trade my stop loss for the opportunity to re-enter at a full daily cycle ahead. As I said, I don't like this idea too much at the moment since we have got a change in market structure, but undeniably we can't take this scenario off the table just yet. As me and Kemazabi were laughing about yesterday, I can already see the comments, right? Flip-flop finance, whatever. I don't care. Unfortunately, this is just the reality of the situation. If we come out of here swinging, okay, happy days. We've got a new cycle and it looks like a brand new cycle should look. If, however, we do see a rollover here, then we do have to be open to seeing something like that. That would really trap everyone, including me. But as ever, I'll continue to take it one day at a time. I'll continue to have full transparency in all of the trades, and I will continue to do my best to stay on the right side. For now, we are long and strong, and we will see what the market can give. If we can get a big push out of here, then I think I can breathe a sigh of relief, pertaining to this trade at least. However, of course, if we do this, if we do indeed set that third and final angle, and all of this occurring against the backdrop of the stock market blowing off, then perhaps that has some ominous implications. As I said, for now, long and strong continue to push. In the level 3 member section, we have been slowly starting to increase exposure via the crypto stocks. I'm taking my time here, okay, because there are still some uncertainties. There are still some more candles that need to be revealed before we can have confidence in what is actually at play here. So I'm certainly not just going to max exposure right away, but slowly but surely, we're starting to add some crypto stocks. We're starting to increase exposure, starting to build some positions. And so long as the market can continue to validate these ideas, then we will continue to increase exposure, continue to build the position up to full size, and be looking to capture that third and final angle should it occur. So what a wild week it's been. What a wild week. It seems to me like we perhaps have got the first of many colder CPI prints. It also seems to me like perhaps these rate cuts are going to show up way ahead of what the market believes. Unless something changes, unless we start to get massive and major technical breakdowns in the very near future, then it seems indeed we are right at the end of this blow off top move that we've been calling for over 18 months. As always, these are not predictions. These are not calls. I do not care about clout or being right or wrong. I simply want to stay on the right side of the trade. I would love to be invalidated on the left translated Bitcoin idea. I would love to be invalidated on the blow off top and a major top and recession in June or July or August. I think it'll be more like July or August. That's my expectation. As always, I'm open to seeing a top come in slightly later. Okay, if it's September, October, November, that's fine with me as well. And like I said a million times, I would rather be invalidated. Okay, I would much rather be invalidated. I would much rather continue to have nice bullish uptrends in all risk assets for many years to come. That would make my life as a trend follower and a trader far easier than having to navigate a deflationary bust in a global recession. And I certainly, from a humanitarian point, don't wish a global deflationary bust on the rest of the world just so I can short a few stocks. Okay, I certainly don't want that. So please don't get it twisted. Don't get confused. I don't want to be able to sit here and say, I told you so. Okay, shorting the stocks, knowing that most people are losing their houses, losing their jobs, struggling to feed their families, having their pension accounts blown up and margin called. Okay, obviously I don't want that. But as I said right at the start, I had an idea. I came up with a framework and I said, let's keep checking in on it every day. There were times when it was tested. Right now, it seems pretty much like, based on my observation, if I just zoom out of this chart and have a look at that, okay, all I can really say is if it keeps going up, then it's probably going to come down. The same is true of that Bitcoin chart, of course. If this thing keeps going up, then it's going to at some point come down. When it comes down, you know, if it's somewhere in this neighborhood or even as late as November, it will have all the hallmarks and character traits of a textbook left translated cycle. I think I said this last week. If I asked you to draw me a textbook example of a left translated cycle, this is what you would draw, followed by a large extended bear market decline into that 4-year cycle low. Again, it's not really a prediction or a call. It's not like I want to say I'm right. It's simply, this is an observation, okay? This does not look like a normal cycle. It does not look like a normal cycle, and that is simply the fact of the matter. I'm your boy Camel. I hope you are doing well in life. I hope you found value here today. If you're a level 3 member, look out for the members only video that I'm about to record for you guys. If you're a member of any other level, look out for the Ask Me Anything and the chart request video that's coming out on Sunday. And for everyone else, I hope you'll consider what I said today. And until next time, God bless. Take care from me. All the best. Cheers. Bye.